Let's play a game of guess the direction. When price stops moving, you will have 5 seconds to decide whether you want to buy or sell. Okay, so are you buying or selling this right here? 5, 4, 3, 2, 1. The correct answer would be buys. Now let's look back and see why. Firstly, we can see that price created a lower low before making an impulsive move to the upside that was able to break through the previous high, creating a new higher high. Price then came down and formed a double bottom which was respected, all of which indicates that there is a high probability of upside movement. So in order to take advantage of this potential upside movement, we must wait for price to pull back into an area of confluence before taking an entry to ensure that the trade maintains a large risk-reward ratio. First, we mark out the key demand zone or liquidity level, and then we take our Fibonacci tool and draw from the low to the high to identify the Fibonacci kill zone. We then wait for price to pull back into this level to take our entry with a stop loss placed below the low or next support level. For this particular strategy, our first target is at the previous high, or the 0.0 Fibonacci level, and the second target is at the 1.27 Fibonacci extension level, for a total risk-reward ratio of around 5 to 1. Let me know how you did in the comments and save this video so you don't forget this setup.